Well, let's digest this further with our market guest now. Ann Berry is Wheelhouse Chief Investment Officer. She joins us now. So as we take a look, obviously, we did see that nosedive that came along with the CPI data coming out. What are markets digesting right now?
It's this disconnect between inflation and expectations just not being hit. People really thought that we were top of inflation levels. We'd really seen the ultimate peak back in March. April wasn't that far off. And so until we start seeing the pace of growth in prices come down, consumer confidence gets hit, business investment confidence gets hit. And that's what we're seeing across the markets now. It's moved just from NASDAQ and it's moving across all sectors.
And what do you think this means for the Fed? I know that this is just one reading since the news that we got last week from Fed Chair Jay Powell, but do you think this changes the calculus or potentially could make the Fed a bit more hawkish than we initially thought?
So interesting when you look at the commentary that Jay Powell made at the last in the press conference after the last Fed meeting, which was there would not be a 75 basis point hike. I do wonder if this is going to push him to be more aggressive than had been anticipated. So, does this change the calculus for the next Fed announcement? Quite possibly. And I didn't think that was necessarily going to be the case last go around.
We're looking forward to Brian Chung interviewing James Bullard, who at one point had referenced a 75-point hike. Perhaps he has come full circle on that. But let's talk about, is there any opportunity out there with 5 straight down days for the Dow and now the NASDAQ down 26% year to date? Where are the opportunities, if any?
Well, I do think we're looking at tech, which for the most part I am, in fact, steering away from. There is one name that stands out to me, and it was one of the names in green on the chart that we just saw earlier in the segment, and that is Alphabet. When I look at that business, you've got extremely strong free cash flow. When you look at it trading on a price to earnings relative to growth multiple, it actually looks like quite good value relative to where it's been both historically and relative to the projections compared to other big tech names. That's one I'm looking at. And then I'm also still bullish on experiential, whether it's music, whether it's travel. The demand is still there, even with consumers feeling the pressure. They're going to be spending on experiences, not stuff for discretionary vacation-like opportunities as we move into the summer season.
And that's interesting what you have to say about people still willing to spend, because we certainly have seen that. We talked to Live Nation earlier this week. Vivid Seats was on the show yesterday saying people are so anxious and so excited to get out there to concerts or to different live events, although it doesn't seem like every company is seeing that happen. Some companies certainly taking a hit because of higher inflation. When does this become a bigger concern? People are willing to spend now, but 2, 3, 4 months down the road, is that still going to be the same story?
I think it really depends on their level of conviction and confidence that this inflation trend is going to change. When you take a look at what's happening to real incomes, wage inflation just is not keeping pace with price inflation. That's where consumers are getting nervous and they're feeling the pain. If we can see the price inflation start to come down, I do think that wage inflation is going to be stickier, and that's where you might see a shift in confidence to the positive. So I agree with you. I think events, I'm an investor in a business called TVG Hospitality. They've got a big opening coming up. They're seeing incredible demand in their new venues. Live Nation, to your point. But I think when it comes to travel as well, the search for travel destinations, looking for a hotel, if you look at bookings holdings and the kind of activity they're seeing, if you look at the airlines and seeing the level of cash bookings they're getting, the amount of interest in traveling, getting out there experiential is still extremely high.
Remarkable to see the increase in airline prices, more than 18%. We focus so much on Wall Street, but on Main Street, there's just sheer panic out there. People looking for some type of safe haven, wondering if they can retire on time. What do you tell someone who's feeling that panic right now?
It's very counterintuitive, and it's very easy to say, but incredibly difficult to feel. But it's to try not to panic. When you look at the longer term returns of the market, whether you enter in the worst of it, meaning the greatest potential upside, or you come in when the prices are highest, over the long run, if you can hold, often you do still get returns that are somewhat attractive. Now, for someone who's on the cusp of retirement, where liquidity is important, that's where I would say look for dividend yields, look for healthcare, look for consumer staples, look for places where you're going to see cash come out with some degree of visibility. And the other place to look, a lot of Wall Street's talking about actually, is in real estate. Start looking at REITs. Rents are going up, to your point, and so that is where cash and cash flowing income can still be generated.
And when we take a look at who is buying there was actually a new Bank of America note that was out today and was saying that more buying of the dip is being seen among retail and institutional investors. So we're seeing interest from both parties here. But I want to focus on the retail investor. What do you think is driving this? Is it simply a fear of missing out? And is there anything from that maybe we should be a little bit alarmed over?
FOMO investing, fear of missing out investing, is always a very dangerous trap. We saw that in the run-up. So if you think about the meme stocks, we saw a lot of retail investors, some with very valid reasons trying to time it, getting FOMO and piling in. We're seeing it now also on the way down. So I think that is part of the dynamic. The other piece of this to me too is where else does the capital go, particularly from the institutions? Europe probably isn't a technical recession. Asia still remains plagued with issues around supply chain. The US, the belief is, still has a strong underlying flexible labor market, still strong consumer demand at its core. And so that's where you're still seeing these inflows. There isn't just attractive yield in any other asset classes right now.
So there is a pinch of optimism. What about inflation having at least appeared to have peaked?
Certainly, when you look at how inflation came out in the numbers today, just north of 8% in CPI, a little bit higher than had been expected, but lower than it was in the prior month. So if it has peaked, and hopefully it has peaked, then that is going to be good for consumer confidence. But again, we need to see CPI inflation. We need to see price inflation come down below wage inflation. Otherwise, we are still effectively all taking pay cuts every day. So that's where we need to see the flip.
Retail investors sort of panic selling, but you have a lot who want to buy the dip, look for the opportunities. How are you distinguishing the cheap stocks that aren't worth buying versus perhaps these undervalued stocks that will rebound, that you have some faith in?
My faith is always anchored to cash on the balance sheet, cash flow generation, a history of cash, and an outlook for where there are new profit streams. And the reason I say that is whether we have a recession coming up, whether we have a little bit of a roller coaster, but ultimately stable growth in the US, cash ultimately is rewarded. Not at the astronomical multiples that you see for the very glamorous tech names. And we've just seen that over the last 12 to 18 months. But cash-focused businesses are stable places. So, for example, Google, that's one I mentioned, or Alphabet I mentioned earlier, and some of the music names, for example, Universal, generating $2.4 billion of revenue in Q1, very strong free cash flow profile. These are the kinds of businesses, if I'm going to put my money somewhere now, there is an outlook that means these businesses aren't going away. There is a path to seeing dividends down the line. And the market, we've seen it with Uber, basically saying it doesn't matter what addressable market is anymore. It doesn't matter what revenue growth is. It's all about profit. It's all about cash. That is the culture now that's starting to infuse investing sentiment. So that's what I'm looking for right this second.
All right, time to get focused. Thank you so much. Ann Berry there, Wheelhouse Chief Investment Officer. Thank you as always.